Let's shift gears then and talk a little bit about the outlook on the logistics space with Rohan Mittal. He's the CFO and Chief Transformation Officer at Gati. Thank you so much for taking time out. Let's begin by talking about the overall outlook, because the market size for surface air e-com is about 25,000 crores. You currently have about a 7 to 8% market share, I understand. What is your target? What are you looking at in terms of growing market share over the next 5 years?
Hi, good morning. Yes, the total market size that you've captured is actually accurate. Within that market size, about 15,000 crores comes from Surface Express, and that's really our core business today. We're about 7.5% of that Surface Express business, and our stated intent is to reach the double-digit number over the next few quarters, let's say FY23 end, and sustain that momentum beyond FY23. So that's really what we are working towards today.
Okay. And what has been the impact of COVID, particularly the second wave, on your company, on the logistics market as a whole? And how have you pivoted or leveraged opportunity during this very trying time?
See, I think the biggest positive outcome of this entire journey has been the digital adoption. I think the pace at which we've been able to adopt digital measures to drive our business, I think that's been really phenomenal. Other than that, what we've been focusing upon really is our employee health, our vendor partner health and safety. That's extremely crucial to us. Therefore, over the last few months, we've been actually actively driving the vaccination program across our operating units, because unless our employees are healthy, we'll not be able to ensure business continuity. Similarly, for our clients, the cargo safety is extremely important, and therefore one of the most important things for us to maintain is that all our operating units, we have more than 600 operating units across the country today, all our operating units remain open, especially during the second wave. So business continuity has been center stage for us during this trying times. We've also seen certain negative impacts, of course. Every time there is a national lockdown, there is a credit squeeze that happens. Yeah, payment cycles start getting stretched. But we are also seeing that as an opportunity, perhaps, for transitioning business from the unorganized players to the organized players, because organized players are better poised to access markets for funds at a cheaper cost. Logistics, after all, is a cost leadership business, and the cost of working capital will remain critical in these times. That's really what we've been up to.
So if you have to compare your business, let's say from March of this year, 2021, how much of your business has normalized because of which got impacted because of the second wave?
See, if you look at the Q4 numbers for GK, our flagship subsidiary, our volume grew by 19% on a Y-on-Y basis. Yeah, from Q4 FY21 to Q4 FY20. As we entered Q1, especially the May month, the e-way bill generation, for example, came down by almost 40% versus the last 2 months. So our industry was also impacted by that, as the consumption and production cycles went down because of national lockdown. Having said that, all our operating units were operational and keeping in tandem with the local policies that were released pertaining to quarantine, etc. But yeah, we did see an impact in Q1. Q4 was phenomenal for us.
Your fixed asset base has dropped significantly from about 520 to about 150 crore. Why is that?
There are two reasons for that. Predominantly, as the new management came in, as all cargo acquisition went through, the stated goal was that we are carrying a lot of non-core assets in the form of land and buildings, which are not actually critical to running the B2B network that we today operate. We've been trying to sell those assets, and we've actually sold quite a few as well. So almost 160 crore worth of assets were moved to asset held for sale which is why you are seeing a drop in the fixed assets. Beyond that, during the Ind AS migration under the previous management, there was a revaluation of certain assets. After consulting with global experts on properties, we've actually revalued some of those assets to a lower price, which we believe is the realizable price today. So those two are the dominant reasons why you are seeing a drop in the fixed asset. There is a commensurate drop in debt because all the proceeds that we've realized from the sale of non-core assets till date have been used to repay debt or bring down our contingent liabilities.
There was a drop that we saw in your EBITDA in Q2 and Q3. What was the reason for that, and how do you see your overall operational performance shaping up, and what has been the impact of the fuel price increase on margins?
The fuel price increase is easy. On a net basis, on an annualized basis, we typically see no gains or loss from the fuel price hikes. There is a clear pass-through mechanism both for our vendor partners and our clients, and therefore we don't stand to gain or lose from any fuel price hikes. The transformation journey really started in Q1, Q2 last year, the turnaround transformation journey. The impact of that was actually visible to a great extent in the Q4 numbers, where when we published our investor report, we've clearly shown that in GKE, which is our flagship subsidiary, our EBITDA margin has more than doubled on a Y-on-Y basis. So we were trending at about 8.3% EBITDA margin. Having said that, the reported numbers had some one-off provisions, which may be non-cash also in nature, because of which we were not able to report the 8.3 margin. But at a business level, we've actually grown margins considerably in the last 12 months.
Cool. And what about your fundraising plans? I understand that it's about 80 crores as of now that's been targeted. What's the timeline, and what is it going to be utilized for?
So out of the 80 crores, 27.5 crores have already come in, and we've allotted preferential shares. Yeah, this has happened to the promoter company, All Cargo. The intent or the utilization of that proceed is very simple. We have applied under the Vivad Se Vishwas tax amnesty scheme to settle our tax-based contingent liabilities. There's a payment of about 23.5 crores that we have to do. The last date is 30th August, and we are in a position to make that payment. With that, our contingent liability will come down to a low double-digit number. We were almost at about 180 crores of contingent liabilities. Most of it was tax-related disputes. Beyond that, the balance money will be used to further retire debt wherever required and invest in upskilling the entire organization on a digital basis, because we really are moving to a digital-first organization. That's really the critical part or path to a cost leadership logistics business, as we see.
Right. Rohan, not today, not tomorrow, not the next quarter, but when you see through, say, the next 5 years, what kind of business visibility do you have? Hopefully by then we should have seen the end of the pandemic as well. But where do you see Gati headed in the next 5 years?
See, let's talk about the market first, and then we can perhaps try and see where Gati might be. The B2B surface express market should be close to about 30,000 crores in the next 5 years, 30 to 35,000 crores, from a current number of about 14,000 odd crores. Today, we are trending at about 8% market share. Our goal is to reach the double digit, and then we believe a 15% market share might be a sweet spot, looking at competition, etc. At that level, we should be able to register 12.5% EBITDA margin on a sustainable basis. We should be able to deliver a 30% plus ROC on a sustainable basis. That's really what we are looking at. The means of doing business will be digitally minded, yeah, and the entire organization, vendor partners, the entire ecosystem will be extremely digitally oriented. Is the way we really look at it. I hope that answers your question.
Sure, it does. Okay, that's the word coming in then from Gati. Also, on a more near-term basis, I'm not sure if you've answered this already, Rohan. Your fixed asset base has dropped significantly, as we understand, to about 520 odd crore rupees in FY20. Could you tell us a little bit about what really is happening here? What's the future plan here?
Our intent is an asset-light balance sheet with negligible levels of net debt. Fixed asset and net debt will move in correlation in our case. We've been monetizing our lands and properties, which are non-core to us, to the business, and using the entire proceeds to pay off our debt. So far, we've reduced our debt by almost 60% as we speak today. And since the time All Cargo took over the organization, we've reduced our debt by almost 60%. Our intent is to actually be a net zero debt company on a consolidated basis. In reality, we'll continue to retain certain working capital limits because of optimal capital structure. But our intent is that on a net debt basis, we should be zero. A large part of the properties have been moved to asset held for sale category because we're in the process of monetizing them. We've realized about 60 crores approximately in the last financial year. We have another 150, 160 odd crore worth of non-core assets which are on the block as we speak, waiting to be monetized, which we're confident we'll be able to pull off in the next 6 to 7 quarters.
Okay, Rohan, great to have you on the show. Thank you so much for candidly and patiently answering all of our questions. Good to speak with you.
Thank you. It's been a pleasure.